This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
You've got the best podcast going, Jason. I love your show, man. It's good stuff.
Oh, thank you. I really appreciate it.
What I wanted to share was my wife and I, for the first time ever, paid effectively no income tax in 2022 through doing a cost segregation study and generating about a $200,000 paper loss on our real estate. I'm a real estate professional, and it really works.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
You create a company that's like close to being a fascist, and then
okay. How am I?
Sorry.
Let's go through this. How am I a fascist?
Dude,
Can you name one thing I believe that's fascist?
You believe that you on. But
I'm such a bad fascist. I let the people who disagree in open mic to talk to me for 2 hours uninterrupted.
Okay.
I'm an awful fascist. I'm more like a free speech liberal of the 1970s, not a fascist.
But I just want to say Turning Point USA is a evil company that was funded by thousands of fracking companies, and
No, it's not thousands, but we do have some frackers that give us money. But
and then all it is making the rich more rich.
Fascism to fracking.
That's all it is. That's all it is.
Okay, again, I'm happy to have a debate. I can see you're getting kind of fired up.
I'm sorry.
So, but why are we evil? Like, we're having a nice discussion.
Because
all of a sudden you're calling me like a
fascist. Because it seems like you just want the rich get even more rich. Like
we haven't talked about the rich at all. I mean, so you don't even know my positions on this stuff at all. The wealthiest people, absent Elon Musk, are all on the left. Jeff Bezos, George Soros, Mark Benioff, Mark Zuckerberg, Laureen Powell Jobs. On the left, yes. Can you name one tech CEO outside of Elon Musk that is a conservative?
I personally think... Let me think. Peter Thiel?
Yeah, that's one. That's one. Larry Page, Google, on the left, worth $120 billion. Sergey Brin, Google, $130 billion on the left. Laureen Powell Jobs, Mackenzie Bezos, Jeff Bezos.
If they're on the left, what has they done that was quote unquote to do the left stuff?
Well, okay, so Larry Page gives money to left-wing NGOs all the time.
If you're on the left, I don't think you will ever be this rich.
Well, they are. You know why? Because the left.
Because they're not.
No,
because they're not.
The left is a scam. The left uses
How is this?
Let me tell you why. It's a good question, actually. The left uses people like you that think that, we're going to fight the rich. Well, they protect their oligarchy. While you guys have to keep on working hard and never own anything, when we conservatives are the ones that actually want to restore the American middle class and bring jobs back to this country.
How would you restore?
Let me finish. The left uses people like you every day.
Who is funding? Dude, I have never seen a leftist organization come to campus spreading their propagandas.
Well, because the whole university is a leftist organization.
No, it's
spreading
not.
Propaganda.
It's liberal. There is a clear-cut difference between a leftist and a liberal. Please make that
You're coming
right.
after this in a good way, because every major, powerful, wealthy person in the country, over $100 billion in net worth, with the exception of one person, Elon Musk, is on the cultural left and gives money to the left. And you guys give them a free pass, because you think that we're fascists, when in reality, we're the ones that are actually fighting to destroy the oligarchy the most.
Greetings, empowered investors, and welcome to episode 2341. Well, the news has been out for a few days now, and it is a very sad day in America and for free speech around the world. Of course, I'm referring to the assassination of Charlie Kirk, the cold-blooded, absolutely ridiculous assassination. I mean, here is a reasonable person. Yes, he believed what he believed, and I happen to agree with most of his beliefs. But, you just cannot have a world where you have political violence like this. It's just absolutely pathetic. And this story, of course, is unfolding, and the conspiracy theories are out there, and the mainstream narrative, I think, has a lot of problems with it. It's just like the first attempted Trump assassination. It's like we're moving back to the 60s where we had all these political assassinations, or, in the early 80s with the attempted Reagan assassination. It's absolutely unbelievable that we're living in a time where this goes on. But yeah, the stories are developing, and I would really encourage you to question the mainstream narrative. For example, let's move back to Butler, Pennsylvania with the first attempted Trump assassination. You think this kid acted all alone, right? It's just unbelievable. Any bad guy that's planning to do such an evil thing like this would want to definitely succeed, because if they don't succeed, they probably will never get the chance again, right? That's the way they have to be thinking about it, because of course the security will tighten. Like Ben Shapiro, for example, canceled all of his public speaking engagements right after the Charlie Kirk assassination. So the idea that these young kids are basically doing this is just ridiculous, frankly. There's just no way. So I'd really encourage you to check out some of the theories that are going around. You're not going to hear them on the mainstream news. And again, I hate to say it, like I hate to be thought of as a person wearing a tinfoil hat, but we are living in an age where almost everything has just become a lie. It's absolutely shocking the way the media is lying to us and the way the deep state is lying to us. You just can't sit back and think you're listening to like Walter Cronkite anymore. Right? I almost said Dan Rather, by the way. Remember when he got caught in his lies? Journalism does not exist anymore. In any real way. There's hardly any investigative journalism, and the powers that be are so powerful. They have consolidated their power, and the money behind them is just making truth a thing of the past. So please keep an open mind and check out alternative media outlets and ask a lot of questions, because nothing is as it seems. It really, really isn't anymore. So today we have got Kevin Erdmann, a housing analyst, on the show. He has a really interesting perspective. And right after this interview that was recorded just about 2 weeks ago, I met with him for lunch. We spent several hours together. He lives locally here in the Phoenix metro area. We went and had coffee after lunch, discussed the housing market, and today we finally got our rate cut. It's too little, it's too late, but things, they are turning. I'll tell you that. There's just a lot more interest in investments and housing and everything that's going on just in the past couple of months. So the doomers have definitely been proven wrong, and with rate cuts, they will be proven supremely wrong. But we'll see how that all plays out. It seems to be a very, very slow moving thing. That was not an effect, by the way. I just did that. We'll see, of course, where that doomer narrative takes us, but it just doesn't seem to pan out. And if it didn't pan out when they tripled the cost of money, it is very unlikely to pan out in any other circumstances. So we will be talking about this stuff and analyzing deals and analyzing the market in general at our upcoming event in Phoenix, Jason Hartman University. That is just 10 days away. I hope you'll join us. Go to jasonhartman.com/Phoenix, jasonhartman.com/Phoenix. We will have basically a full day of education with yours truly and some other guest speakers, and that will take place over 2 days because that'll be split up. Saturday afternoon, we're going to get on the bus and we're going to go tour properties. And the exciting new things at this event are, and these are new things, we're going to discuss home equity investment, a really exciting way that you can get equity out of your property without any debt, without any payments, and really be able to use that money to do my refi till you die plan on steroids. I mean, just to take refi till you die and put it into warp drive, okay, and make it go faster and better and easier, because again, no new payments, no new debt, nothing on your credit report. It's just incredible. And I don't want to say nothing on your credit report. There is an inquiry on your credit report, but not any new debt added to your credit report. Okay, that's the distinction. So we're going to discuss that. And for the first time ever, and I have waited about 5 years to bring this up, we will sell no wine before it's time over here at Empowered Investor, and that is co-living. We're going to discuss some very, very unique co-living opportunities, properties that you can buy for around $550,000 that generate approximately $8,000 per month when they're fully occupied. I mean, phenomenal return on investment for these properties. So really exciting new stuff. And the other, I guess, new thing, but it's not totally wild new as those last two things are. And by the way, let's just go back to the co-living for a moment. I really waited to bring this to you because I wanted to make sure they got past some of the growing pains and some of the problems. Like I said, we will sell no wine before it's time, as Ernest and Julio Gallo used to say on those old commercials. God, I really am dating myself, huh? Hey, speaking of dating myself, we're also going to celebrate my birthday because it is right after this event. And we're going to do that on Saturday evening and have some fun. We're going to have a great dinner together. So that'll be great. But back to the co-living thing. When I checked this out about 5 years ago, I was very skeptical and I just didn't want to bring it to you. So I've been watching this and now it is ripe. It is ready. And we've got the teams lined up. And that's going to be a great opportunity. So co-living, home equity investment, and what is the other thing? Well, the other thing is not as crazy new or wild, but it is very, very motivated new builders, new home builders that are selling properties with giant incentives that we have pre-negotiated for you. Okay, incentives for closing cost, upgrades, packages that are just going to blow your mind, and buy downs to make those mortgage payments even lower than they already are, because we have the lowest mortgage rates in almost a year now, and we had another Fed cut just announced. So that's exciting. It is too little too late, but at least we're moving in the right direction. I think we're going to see a couple more cuts, maybe one more this year and then some more into next year for sure. And good old Jerome is out. We know he's getting out. It's not that many months away before he's gone. And we're going to see a much more accommodative Fed chair. Now, what will that do? Of course, that means upward pressure on prices as housing becomes more and more affordable. A lot of very good stuff to look forward to there. So join us for that, jasonhartman.com/Phoenix. And one other announcement I do want to make, and that is my chatbot, the AI, the clone of yours truly. A lot of you have a lot of questions about this, that, and the other thing. And this is trained on 1,800 of my podcast episodes. It is really quite good. In fact, I would argue that it's better than asking the question of me, right? And it's totally free and available to all of you. Just go to jasonhartman.com/AI and ask it anything. I mean, try and stump it. It's our 4th attempt at this. We've had this chatbot for maybe a year or so, and it is good. A lot of you are using it. Now, what's interesting is this, is that those of you, we look at the statistics once a week of the usage of the chatbot, okay? And by the way, this chatbot, you can text with it, but you can also talk to it. You can literally talk to it on your phone, and it has like a clone of my voice, and it'll answer any question you want. It's got not only my knowledge, but it's got the whole internet behind it as well. So it's pretty incredible. It really is. Anyway, take advantage of that. Get your questions answered. Ask it about refi till you die. Ask it about the Hartman Comparison Index. Ask it about inflation-induced debt destruction. Ask it about self-management of your properties. Ask it a specific question See if you can stump it. Ask it, I have this property in such and it does such and such, and what should I do with it? Should I keep renting it? Should I sell it? Should I refinance it? You ask it those kind of questions and see how it does. And if you can stump my AI chatbot with a fair and reasonable question, you are invited on the show. And you can tell us how you stumped it, and then I will answer the question. Hopefully I can, and you won't stump me, but we'll see. Anyway, that's all that's available for all of you. What we're noticing, here's what I wanted to say. What we're noticing is that those of you who are using it all the time. You're just using this as a tremendous resource for your financial freedom, and you're coming back to it many times a week in some cases. But we're not getting a lot of new users because I just haven't really mentioned it enough. And I want you all to take advantage of this. It's a great tool. jasonhartman.com/AI, or you can find it at the front page of our main website, which is jasonhartman.com, or on the front page of propertytracker.com. And inside the Property Tracker software, we put it there as well. Just click on that little superhero character that looks like the one on my shirt right there. And the superhero will help you answer any of your questions, any question you could possibly have. Take advantage of it, totally free. And so far, it's unlimited. We may have to put some limits on it if it gets too expensive, but right now it's unlimited. So you can ask it everything and anything under the sun and get your answers. Anyway, we hope to see you just real soon here in Phoenix. We're going to have a great property tour and educational program. So that's coming up, jasonhartman.com/Phoenix. Without further ado, let's get to Kevin Erdmann. It is my pleasure to welcome maybe one of the most interesting housing analysts. This is a guy I've been wanting to interview for a while. I love his work, and it's Kevin Erdmann. He's the author of 2 books, Building from the Ground Up, Reclaiming the American Housing Boom, and Shut Out, How a Housing Shortage, yes, you heard that right, how a housing shortage caused the Great Recession and crippled our economy. Kevin, welcome. How are you?
Yeah, great. Thanks for having me.
It's good to have you. So, most people would say, and you might change my mind on this because I probably would have said that the reason we went into the housing crisis in the 2007-2008 era is because we had an oversupply of housing. Do you differ with that?
Yeah, I think we had even in 2005, our biggest problem was we didn't have enough housing.
Okay, that's mind blowing. Most people, you're like you're a lone wolf. I think I haven't heard anyone else say that. I mean, that's just huge. That's a giant statement because many have tried to compare the era we're in now, really for the past several years, to 2008, saying we're going to have a crash, we have an oversupply. Of course, I completely disagree with that thesis. I think we have a housing shortage, but how would we have had a housing shortage in 2007, 2008? I mean, you look at the charts, there were a lot of houses and houses sat on the market for a long time. And, there was a foreclosure crisis because people couldn't sell fast enough. How do you get there?
So I'll start off with a sort of a little detail, and then I'll give you the broader story. The little detail is that, and there's a post I have at my Substack on this. Joseph Stiglitz, who's a Nobel Prize-winning economist, just recently in the last year or so talking about the Nevada market, and he had this whole story about how they built all these houses in the desert that nobody wanted, and again, told that story of there being a glut of housing, and that's what caused the crisis. And if you can go to Fred and look up permits in Nevada or permits in Las Vegas.
So that's the Federal Reserve, the St. Louis Federal Reserve website, Fred. That's okay. Go ahead.
Yeah. I think it's fred.org. I think is the address. So you can type in, the number of housing permits in Vegas, and, to make it sort of level over time, divide it by population. So it's sort of permits per capita you can get data from probably like 1990 to the current time. There was no building boom in Las Vegas. The number of homes permitted in 2005 was no greater than it had been in any typical year for the decade or whatever before that. So there was a spike of demand to get into Vegas that was mostly people moving out of California because they have a shortage of housing that I think anybody can easily imagine that even in 2005, LA and San Francisco had a shortage, right? So over the course of the 2000s, that shortage led to this flow of families out of those cities looking for a place with housing. They went to places like Vegas and Phoenix. Vegas didn't build any extra housing for them. Phoenix built a little bit more. And so those places look like bubble cities, but they were really, not even keeping up with the demand that was coming from cities that definitely, clearly, nobody can debate they have a shortage all the time. And so that's really this, the story is that there was a regional shortages in New York, Boston, LA, San Francisco. Those created a migration event that from the Northeast, they go to Florida, from California, they go to the Mountain West. And so those cities, had technically had a bubble in the sense that there was this spike of demand that probably wasn't going to continue forever, and those prices in those cities were going to revert to a norm. But it was all triggered by a lack of housing, regional lack of housing, and then an inability of those other places to keep up with the demand of families moving out of those places. And even looking at any of the cities like that had a little bit of a building boom, like Florida, the Florida cities or Phoenix, by 2008, housing starts started to decline by early 2006. By 2008, there was no city in the country that had construction trends that you could still say, were above a sustainable level. By 2008, construction everywhere was already below a sustainable level.
Okay, so it sounds like, just correct me if I'm wrong here, I want you to say this another way, maybe, because this is a pretty big theory. Okay, it's a pretty big statement on this. It sounds like you're saying there was a regional housing shortage in, say, the coastal markets, and that led to developers building more in the markets those people would migrate to.
Yeah.
Okay, and then they overshot. Is that what happened?
They didn't overshoot.
Why did Phoenix have a bubble? Why did Phoenix's bubble pop?
So first,
because Phoenix, and by the way, look, Kevin and I are both in the Phoenix metro. Okay, first of all, and I always liken it to a wave, right? There's this wave of migration and money that leaves California because, of course, the California government is a disaster and then some. Okay, and so people leave for a lower cost of living area. I call it the water theory, right? If you spill a glass of water, it goes to the lowest point. And money does that too, right? It finds the best deal. And so when you think I could have a better quality of life in Phoenix than I can in Los Angeles, I'm going to move. And so I'm going to take my money with me. And, that changes the housing dynamics, obviously.
Yeah. So that's what happened. There was, and I would preface this by saying the last place you could possibly have a glut of housing is a market like Phoenix that's at the time was growing by 3 or 4% a year. Builders couldn't possibly build more than 6 months of excess inventory, right? When you're growing at that rate, right? So you really couldn't have like years worth of inventory that the builders just like clumsily like accumulated, right? They stopped building when the houses stopped selling. So what happened is Phoenix was growing 3 or 4% a year. Now, the first thing that happens is the Fed starts tightening the money supply specifically to kill the housing market. Like in their minutes, they say we need to raise interest rates more because we haven't killed housing construction yet. Yeah. What they didn't understand, what they were really doing was killing that migration, right? When we get into recessionary conditions, people stay put. They stop escaping those cities. And so Phoenix goes from 2006, 3 or 4% growth every year to suddenly by the end of 2007, that's almost dead. Like it's gone from like 3 or 4% to barely any growth at all by 2008 and 9. And there's just no city that's going to deal with that level of volatility and population growth without having problems. Now, then we added to that in 2008. The federal regulators basically killed off about a third of the mortgage market through regulatory crackdowns. So now, in addition to that, now you just have all these knock-on effects of new buyers can't get mortgages, foreclosures start happening because there's no buyers for the existing homes. So I actually attribute, there was some sort of reversal that had already happened in places like Phoenix by early 2008. Everything that happened after that was a result of the mortgage crackdown. The entire loss of $5 trillion of real estate wealth was due on net across the country was due to the mortgage crackdown.
Kevin, you said something very important here there, and you made it as a very casual remark. I just want to make sure people pick up on that. Real estate is a credit-based asset. 60% of the country at this point uses a mortgage, which, by the way, is the lowest ever, well, in modern history, at least. In the old days, I'm sure a lot of people paid cash too. Okay.
Yeah,
but, 40% of the country owns their home free and clear, which is another reason we haven't had a housing crash that the doomers have been predicting. So here's the thing that a lot of people don't understand, and a lot of the doomers play on this when they say, I call them the crash bros too. Okay. Yeah. The crash bros and the doomers say, hey, the market's going to crash because real estate is too expensive. Uh-huh. And, that's sort of like a part of it. Sure. Yeah. But what they don't say, and they were predicting crashes since the beginning of time, basically, but they were certainly predicting them in the early COVID era. Okay. Yeah. And the complete opposite happened. The market boomed. It went up, 50% almost in some places. Yeah. But what, as long as people have an exit opportunity, then, and if you have a strong market or easy mortgage money or semi-easy mortgage money, even if people are in distress, they can easily exit. Okay. Mm-hmm. It's when they're in distress, plus they can't exit, that you have a problem. Okay. Yep. You can have lots of people in distress that can't afford their house. Yep. But as long as they can exit and there are new people that can take their house for them, you're not having a crash.
Yeah. Yeah. And, you can really see this, the other thing about the 2000 to 2008 market is you can really see the differences regionally back then. 2/3 of the country didn't have a construction boom, didn't have a price bubble, everywhere between Denver and Washington, D.C., home prices went up 3 or 4% a year. Construction rates were about the same as they had been for a decade. And then you look at a market like Atlanta. Again, no construction boom, relatively level prices. And then suddenly in 2008, for FICO scores below 760, the mortgages get cut in half permanently over the course of 2008.
Mortgage availability gets cut in half.
Mortgages.
So in other words, those subprime borrowers could no longer borrow.
Yeah, even prime borrowers. And so for credit scores below 760, the number of mortgages approved gets cut in half immediately and permanently. And in a market like Atlanta, of course, construction collapsed. At the high end of the market that's not credit constrained, prices didn't really go down much. They were pretty level all through that, going all the way through the next decade. The low end of a market like Atlanta, where again, nothing unusual had happened before, prices went down 60, 70, 80% in the lowest in, the most credit constrained neighborhoods, the poorest neighborhoods lost more than half their value. For no reason, there's nothing, it wasn't a reversal of anything, right?
Look, this is the era during the Great Recession of the $30,000 house. Okay. Yep. Where you could literally buy houses for $25,000, $30,000. Heck, in Detroit, they were giving them away for $1 in some cases. These are houses that just like nobody wanted. And when
they wanted them, they just couldn't, the bank wouldn't let them get the money.
Yeah. Right? Well, when the subprime thing blew up, there was no financing for those properties either.
Yeah. Well, and so I would say there's two very distinct periods. There's the subprime boom and bust which very distinctly happened from the end of 2003 to early 2007. And you can see the effect that had on home prices. And it had an effect. It was overstated because most of the high costs were from the shortage, from the lack of supply, driving rents up. But there was some extra, I have a paper that I did for Mercatus, the Mercatus Center that, where I attribute on average about 8 or 9% extra inflation in prices from the credit boom, from the subprime boom in that period. But that was over by early 2007. And then there's this very distinct separate event, which was basically cracking down, well into the prime area through the federal agencies on conventional loans that happened very distinctly in 2008. And again, you can see that in a market like Atlanta, where there was very little that was happening because of subprime, but you can see the collapse that very distinctly happens when prime credit was now in the story of the bubble and bust, that all gets conflated into, oh, we just had too much credit and then we had to reverse it. But this thing that happened in 2008 was unprecedented. It wasn't a reversal of anything that had happened before, and the results of that are very easy to see when you know where to look for it in the data.
You know, I like packaged commodities and tangible assets when investing. And that's why I'm sharing this solution, a powerful way to get paid on gold. You own gold, you get paid a yield on gold. Thousands of investors are earning interest in physical gold and silver. With Monetary Metals, it's time you do the same. Visit monetary-metals.com/Hartman for special offers. Well, you know, the old saying, of course, those who don't learn from history are doomed to repeat it. So it's good that we cover this. But Kevin, take us to where we are today and into the future, as much as you're willing to. What is the state of the housing market currently? So,
I just call it the long, boring recovery. Basically what I would do if you take a chart of American home prices, and actually compare them to, say, Australia and Canada that have a lot of the same background fundamentals, but they didn't have this mortgage crackdown in 2008. So the home prices in Australia and Canada are just a straight line up from the mid-90s till today, right? Canada's had a little bit of volatility recently, but they're basically a straight line up. The United States home prices are also a straight line up, except in 2008, it's sort of like this fissure where you cut the graph in half and you moved the chart after 2008 down by 50%. And so I would say that fissure was the mortgage crackdown. It was a one-time event. We can't repeat it because I say you can't cut your leg off twice, right? We already amputated a third of the mortgage market. We can't take that away again. So really, we look like Canada and Australia, but with this fissure, and that fissure can't repeat. So really, if you think about the fundamentals of housing, it is actually a straight line up over the last 30 years, driven by the lack of supply and rising rents. And so I think, the boring recovery is going to continue. I think, we're basically hitting capacity constraints right now in construction that have still been sort of exacerbated by COVID, disruptions. As we get past those, we'll continue to sort of a traditional market where every year we're building an extra 100,000 units compared to the year before. Eventually, that will get to where we're actually building a sustainable number of homes for the first time since 2005. And eventually,
so I've read these studies where they say that the housing market will be in a shortage state until 2032. Do you agree with?
Yeah, I think it'll take longer than that. I would put most people put the shortage, a few million units. I would say we're 4 or 5 million vacant units short of a functional market. Like, we need to build 4 or 5 million units that are filled and leave vacancies in the existing market with no household formation at all, just to get back to normal. And we're probably somewhere north of 10 million households short of households that would have formed.
So the estimates are, the lowest estimate on the shortage, it comes from Zonda, and that's my friend Jeff Meyer's company. Known him for 30 plus years. They say we're 1 million units short approximately. And the highest shortage estimates go to like 7 million short. You actually say our shortage is worse than that. It's 10 million homes. Now,
15 or 20. Yeah.
Oh, okay. Well, hang on a second. So I always say, compared to what, right? There's about 140 million housing units in the country. There's 341 million people. There's X number of households. I don't have that off the top of my head. So you don't say we're 10 million units short. You say we're 15 or 20 million units short.
Yeah.
How do you arrive at that? That's a big number.
Yeah, there's a few different.
But as a real estate owner, right, and investor, and everybody listening is an owner investor, I kind of hope you're right.
Yeah.
because the shortage means upward pressure on prices and rents.
Yeah. I mean, there's a few different sort of back of the envelope ways to get at this, and they all sort of get at a similar number. First, rent inflation has been above general inflation almost every year, for the past 30 years.
Yep.
When we're building, that didn't back when the Case-Shiller index was flat for 100 years, rent inflation was moderate. It was the same as general inflation. In fact, the real Case-Shiller index is deflated with general inflation because Professor Schiller says rent inflation can't be excessive over the long term because people will build. Well, I'm sorry, Professor Schiller, but we have like 40% of cumulative excess rent inflation at this point. So,
I mean, listen, I have a lot of disagreements with Schiller. When I read one of he's got a couple books called Irrational Exuberance.
Yeah.
And I read one of them back in, I want to say 2005, circa 2005. And I wanted to throw the book at the wall. It's like he didn't get it. And he's a Nobel laureate, right?
Yep.
I've never interviewed him. I mean, he just like oversimplified things so much. And he had this like dumb comparison of the S&P to housing. And, not even mentioning that most people buy housing with a mortgage and use leverage to amplify their returns. Yeah. It was just an idiotic analysis, honestly, with all due respect. I mean, I know the guy is supposed to be smarter than me, but sometimes just, having like less academic knowledge, it serves you better. You have more common sense, it seems like, but
well, and to me, like that actually was the cause of the crisis, the 2008 crisis, because it got so universally sort of held that a normal market had to include home prices collapsing. And so if it took a crisis to make that happen, we were committed to that. Like that 2008,
to make the crisis happen.
Yeah. I mean, it was the most popular public policy in my lifetime, was making that crisis happen. Today, if you go out and talk to the guy at the end of the bar and say, hey, we should have tried to avoid that crisis, they will be angry at you for suggesting that we should have let people off the hook, right? So very briefly, in 2005, at the height of that construction cycle, rent inflation just touched down to general inflation. Like we were almost building a sustainable number of homes nationwide right when we killed that market off. So, one way to do it is just, add up, compared to that construction trend, how many units have we not built compared to what we were building the last time we got rent to just barely become normal. And you add up all those years, we're 15 or 20 million units below what we would have been building if we kept building at that rate.
Yeah, and then you have to ask what happened during that time to population, number one, but really more important than population is household formation growth.
So there's two other ways I would look at it. The second way to look at it is really just, look at that cumulative rent inflation. Historically, families have a very strong tendency to want to spending on housing is very much income driven. Right. On average, something like 10% of GDP wants to go to rental value. And that was the case for decades before 2000.
10% of GDP, but about 33% of income.
Yeah, and there's a little bit, richer households spend less than poorer households, so that that's sort of like an average, and it depends on what income you're counting and that sort of thing.
Sure.
And if you're using median versus average, another way to look at it is add up all that cumulative rent inflation. Typically, demand elasticity is about 2, and in fact, if you divide expenditures on housing over the last century between like real expenditure, like how much did the quality of our homes increase each year relative to our real incomes, and how much did rents inflate compared to general inflation. Basically, for every 2% of rent inflation, families reduce their real spending by about 1% to try to compensate. That's under a shortage condition. If we didn't have a shortage, people would just increase their real consumption until we got to that 10% average spending. But under a shortage, they start spending more of their income on housing, and
as a percentage.
But they're trading down over time to try to get rid of some of that extra spending. So you could,
you said so many things there, and that's capitulation. I definitely, that is what it's like. Every economist seems to miss the point of capitulation, right? In other words, Kevin, people enter the market and they want more, but they can't afford more. So they take what they can get. They capitulate, right? And it's like you can't measure that, but we know it happens because we know that as market participants, we go out there and we try to get the best thing we can with the money we have, right? Yeah, that's true. But before you go on, I just want to throw this up because you mentioned it a minute ago. This is a chart of total housing inventory. And what blows my mind about a chart like this, here we start in 1980, okay, and we go to 2025, and we see that there's a housing shortage.
Yeah.
But what we don't see, I always say to my listeners, Kevin, always ask yourself, what is the chart not telling you? Where are the dogs that aren't barking in this chart? And of course, that's population growth and household growth, household formation growth. And this is a giant span of time. Okay. This is decades. And the chart is not adjusted for population or household formation. Doesn't that just blow your mind?
Yeah. And this is the thing.
Overlay that.
Yeah. Somebody that I sort of go after him a lot is a UCLA economist, who recently passed away. So it's crazy because, every year, in fact, they just did it. The Fed has this meeting in Jackson Hole in August where they sort of talk about the most important issues. And in 2007, they talked about housing, and a high profile economist from UCLA was one of the presenters there. And it's actually a very widely cited paper, and the paper itself is really important and useful. It's called Housing is the Business Cycle. And he shows that you can predict when recessions are going to happen because housing starts and collapse first. And so the way to sort of avoid recessions is the Fed should watch housing starts, and when they decline a certain amount, then they should start stimulating the economy to get a recovery to happen. And he's talking to them in 2007 at a point where housing starts are less than half of what they had been at the peak. And he has this beautiful paper that is very useful, and he doesn't take his own advice. He tells them this time's different. We had a glut of housing, so this time housing starts won't recover, and you shouldn't try to make them recover. And his way of analyzing it is exactly what you just showed. He shows housing starts over decades without adjusting for population growth, as if there's just this unchanging mean cyclical level of 1.5 million units a year or whatever that you have to go around. And it's such a simple mistake.
I know.
And here's the guy that figured out how important housing is in the business cycle. He's at the most important seat in the world. He's in the room where it happens, and he tells them this time you're just gonna ignore this.
He's influencing the most powerful central bankers on planet Earth. Okay.
Yeah. And he's not adjusting for population.
I know. Listen, everybody listening, please hear this. The experts are wrong all the time. They're drinking their own Kool-Aid. They don't get it. They don't do in-depth thinking. They don't back test their own ideas. They just get it wrong constantly. So be careful trusting resumes or Nobel Prizes for that matter. Okay. I mean, it's just amazing to me. We were talking about Schiller before, and I just cannot believe the stuff he misses. But it is what it is.
Okay, yeah. So there's real quickly, there's two other ways that I get to that 15 to 20 million number. And again, you can
on the shortage.
Yeah. And again, you can look at, basically under shortage conditions, people consume less but pay more for it, and with the total adding up to more of their income than they would like. So the odd thing is, total residential real estate value has gone up maybe 50, 60% as a percentage of GDP or percentage of incomes over the last 50 years. That is the only way that could happen is because we have fewer homes. Because of this inelastic demand, the only way you spend more on housing is actually by having less. If we had plenty, people would just spend the comfortable amount, and homes would be worth a comfortable amount. So you can really just take those two, real spending on housing and rent and excess rent inflation, and come up with your own estimates of how much it would take to get those back to normal. It tends to come to me to 15 to 20 million. The last thing is that population has...
Wait. Mm-hmm. How many homes are we building every year? That's the question.
We're about 1.5.
Let's do the math on how long does it take to cure the shortage. So if you say the shortage is 15 to 20 million, others say it's between 1 million and 7 million, your number's higher. But how it's going to take 15 to 20 years to cure the shortage in your mind, right?
Yeah, we're at about 1.5 million units a year now, and I don't think we can grow that much more than about 100,000, 200,000 a year in terms of the pace. So I think we could spend a decade building 2.5-3 million units a year if we let it happen.
And keep in mind, there's what are we not telling you? What is the dog that doesn't bark in that statement we just made? The dog that doesn't bark is a lot of houses will become obsolete. So there will be this obsolescence problem where old housing stock is just no good. Okay. So it's not like the stock is stable and it just stays there forever and we just add to it. We also subtract some. Okay. So go ahead.
And then the last thing is the population thing. You have to be a little bit careful about. A lot of the doomers will show lower population growth and they'll say we have more homes per capita than ever. And so we couldn't have, but that's
and population growth is slowing.
It has.
But you have to adjust everything by 25 years. Okay.
Yeah.
We don't see the impact. If people don't have babies today, we don't see that impact for 25 years. Okay.
Yeah. And so one of the other things you can do is look at adults per house.
Right.
The thing that's gone down in the last decade is
the
children
number of people per house. Yeah.
Yeah. So we have fewer children in each house, but adults per house follows a very linear pattern from like 1960 to exactly 2008. Declining. I don't know what it is like.
A little bit more people are single, but
exactly. So like every year, maybe it goes goes down 0.05 of a person of an adult per house, and it goes like this, and then 2008 happens and it reverses, and the number of adults per house has been growing since exactly 2008. And once you get this bigger story that I have of everything that's happened in the mortgage crackdown, making so people can't buy homes, the obvious cause of that was this crevice we created in the housing market. And when you add up the number of adults per house compared to that long-term trend, it's something like 11 million adults that would probably be heads of households if we hadn't engineered a shortage. And then you add in 5 million vacancies that we should have, and you're up in the 15 million range.
So is that the failure to launch concept? Is that what you're saying there? Because I've done some research on that too. And that's the adults that would be, they represent shadow demand. Okay, they're living at home. They shouldn't be living at home. They should be out on their own by now, but they're just not doing it. Okay, and so there's this failure to launch problem. But eventually, those people do launch. Okay, it doesn't last forever.
And of course, we tend to naturally want to talk about these things in terms of price, like the cost is keeping them from doing it. Or when people move out of LA or New York, we talk about the cost. But the cost in this context, the cost is really a mechanism. Like that, literally, there's room for X number of households in LA next year, and the average rent on a house in LA is the rent it would take to make 100,000 people move, so that the number that's left is the number they have room for. The easiest way to think about it, is in some ways isn't so much thinking about the cost and what needs to happen with the cost. It's a household's not going to form unless there's a house, right? Yeah. Once the house gets built, somebody's going to claim it. Now, eventually that has knock-on effects on the cost, but you can't form households without houses.
Yeah, right. That's obviously, yes. Yeah. A lot of people forgot about that. So very, very good point. Very good point. The last thing I want to ask you about, we got to wrap it up. I want to have you back a lot more often, but fertility and the economy and construction and homeownership rates. I mean, fertility rates are way down. For the European American population, they're way, way down, which is tragic if you ask me. That's true in Europe. Russia, I mean, like white people are going extinct. Okay, my race is going extinct, sadly. But tell us about your thoughts. You recently did a newsletter article on that.
Yeah, I mean, I think that's going to have, over the long term, some depressive effects on the number of homes that we need, to be sustainable. As you said, the fertility turned down in 2008. That doesn't really affect the housing market until 2038, right? So we're quite a ways away from really, people will make the argument that we don't need to build homes because of this. Well, for the next decade, people need homes, and the housing market be defined by what you think is going to happen in 2050.
Yeah, now, I completely agree with you. Look, all of this changes, in my opinion, in the late 2040s. I will be singing a very different tune then, okay? Yeah. Because the housing shortage will be resolved by then, most likely. This all changes, but it's going to be a very long time before that happens, and that's the important thing to consider.
Yeah. And, the other thing is, like so many things, that trend, there's a sharp trend shift in 2008. That trend shift is caused by the housing problem. So once we don't have a shortage, I will probably get some recovery in fertility. Now we have this divot in fertility, that'll sort of work its way through. But probably if we keep building more housing, probably by 2050, 2060, the number of new home buyers will actually be probably recovering a bit because families aren't having as many children as they would like to because of the housing crisis.
Right. And interestingly, those DINKs, those dual income, no kids people have a lot more to spend on housing. Yeah. So, because children are expensive. So there are so many factors and layers to all of this stuff. Kevin, give out your website. People can find the books on Amazon, of course, but give out your website.
Yeah, it's the Erdman Housing Tracker, Erdman with 2 N's, kevinerdman.substack.com. And give it a look. And that's where you can find me.
Good stuff. Kevin Erdmann, thank you so much for joining us.
Great. Thanks.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.